Yes, the balance sheet does matter to the value of your business. Hi, everyone. I'm Josh Horn of Horn Valuation. I help business owners and attorneys in business valuation issues. And I had a client who recently was, we together were having trouble getting information from his accountant. And I think in the frustration that the accountant had in getting the information pulled together, he told my client something that made my heart skip a beat, and that was, well, the balance sheet doesn't really matter here. And that's wrong. It's not true. I think this comes from a thought process that earnings or EBITDA or seller's discretionary earnings or whatever term it is going to drive the value of the business, and that's going to be it. And that is not always going to be the case, or at least it's not going to be the only factor that's going to drive the value of the business. And let me point out three important areas that I look at every time I value a company that will be directly related to the balance sheet. The first is the working capital of the business, or the current assets less the current liabilities. Or those of you who are not accountants, that basically means how much cash cushion or current money's available cushion do you have to be able to cover what you got to pay out very soon. All right? Can you meet the next payroll? Can you handle the next check run? Or do you have to dig into your pocket or borrow money to cover that? That's working capital. In this particular case, my client had a significant cash cushion working capital balance. So that definitely is going to matter to him in this valuation of his business, and it did in the one that I prepared. The second thing I like to take a close look at is the debt to equity ratio. How much debt does the company have relative to how much equity or capital does it have? Too much debt can burden the business with a lot of payments that it can't necessarily always handle, and that can also cause the business to have a higher risk. Too little debt, the business is actually not taking enough risk or utilizing debt enough to build the business as well. And then finally, look at what I like to call the floor value of the business, which is generally an estimate based on what the value of the assets are less the liabilities. So you subtract the liabilities away from the assets, and you can get a rough idea of what the fire sale value or liquidation value of the business might be if basically the doors were closed tomorrow, which can be important. And in fact, my client actually brought this up to me directly while I was working on this, because he's a smart guy and he figured this out on his own. It's as he described it, it's kind of the foundation that you lay the business on, and then from there you work up. And I thought that was a great way to describe how you establish the floor value of the business, and quite frankly, how you describe the importance of the balance sheet in general. So this has been great talking to you. I appreciate your time. My name is Josh Horn, CPA of Horn Valuation. The balance sheet does matter in valuation. Have a great day. Bye.